Good afternoon, everyone. Somebody could come through, just confirm that you can hear me, maybe in the chat box or the question box. Just let me know you guys are getting good audio and can see the presentation that's queued up. I would appreciate that. Thank you so much. I appreciate that. I'm going to give everybody a couple minutes to finish getting logged in here. See, folks are coming in quite a bit. So we'll get started in about 2-3 minutes. I appreciate it. Thank you, everybody. All right, we'll get started here. Good afternoon, everybody. Thank you for joining the webinar today. My name is David Diaz. I'm with Walker Reed Strategies. I'm the managing partner over here, and just wanted to take a little time this afternoon and go over some of the changes that we have coming up with Section 179D, Section 45L, and some of the energy tax incentives that are so near and dear to our heart here at Walker Reed. So figured we'd share them with some of you guys. I see a lot of our clients and some other folks up on joined. Thank you so much for taking your time this afternoon to listen to what I got to say on some of these topics. Hopefully you'll find them informative, and hopefully we can help our relationships continue to flourish and us do business together here in the future. So great. I'm gonna do something a little different today. I just it's hard for some of you folks. I know some of you folks are very familiar with 179D. I also know some of you folks are also extremely knowledgeable around the basics around 179D. So I'm actually going to kind of invert the presentation a little bit. I'm going to get right into the meat and potatoes regarding some of these upcoming changes around the Inflation Reduction Act, Prevailing Wage, and then I'm going to roll back to the original 179D and how 179D originally works, and 45L as well. So I'm gonna kind of start from the end, kind of like a good sequel. I'm gonna start without giving you guys too much a backstory, and then if you're interested, I will jump back to the beginning of the presentation and go through some of the topics that are related to the original use of 179D, how it works, and how it applies. So if you have some questions and you're kind of confused on that end and you're not really familiar with 179D, just hold on a little bit. we'll definitely get to you, and we'll get to all those, probably clarify a bunch of that too. That being said, a couple housekeeping things I'd like to just discuss. If you could, please keep all the questions in the Q&A. Feel free to type them in. If you look at your bar, you'll have a Q&A section. Feel free to type in those questions as we go. I'll do my best to take a look at them, and take a peek and get you them answered. Pretty much, I'm going to have a question and answer session at the halfway point, which will be once we get through all the prevailing wage items and the Inflation Reduction Act changes, and then we'll circle back to the kind of the beginning, the original 179D, where it currently stands today, and we'll have another Q&A at the end of that. So like I said, a little bit of backwards train here. I will just talk a little bit about us and about Walker Reed before we get started. So Walker Reed is a energy tax incentive provider. We work pretty much exclusively around the Section 179D and the Section 45L, which 179D is a energy efficient commercial building tax deduction, and the 45L is a residential tax credit for energy efficient commercial home, energy efficient homes tax credit. So multifamily or single family homes, any dwelling unit that's used for residential purposes falls under 45L. Commercial buildings, government buildings, multifamily that's 3 stories or larger or higher in height fall under the 179D commercial side. Our firm works with CPAs, energy companies, you name it, we do it, developers, real estate investors. There's a wide gambit of folks that we do business with. And once again, I'm really appreciative of all of you guys on this call. We work with tons of the cost seg groups, fixed asset practices, other specialty tax firms. So throughout the years, we've been able to create great relationships with you guys, and for that we're very thankful. So and again, we also work with some end users as well. So we can definitely help you on any aspect of what you're looking for. We're highly experienced in this space, gone through plenty of audits, gone through IRS scrutiny. So we're always going to try to guide you down the right path as far as what you can do with 179D and 45L, and make sure we maximize the incentive for you, and 2, we keep you call it out of trouble with the IRS and audit risk and whatnot as we move forward. So with that being said, I'll jump right into it. Let's get into hold on. It's always fun. I love my Game of Thrones slide. It's my new favorite slide. So there's big changes coming around 179D and 45L. This may be a repeat for some of you guys, but in order to really understand what's going on and some of the main content of this webinar, which will be the prevailing wage and apprenticeship requirement, you got to kind of understand what the changes that were made as part of the Inflation Reduction Act. So back in a couple months ago, Congress signed a bill that extended 179D and made some changes to it for the next 10 years, and 45L as well. And it's exciting. So we finally are starting to see a little bit of the guidance and a little bit of the notices come out from the IRS. One of the major ones that and it was the overall theme in the Inflation Reduction Act. It was kind of sprinkled throughout, was prevailing wage being a requirement for the construction and the capital spend on some of these projects. So it was a big sticking point that really wanted to focus on having those incentives being given out, and for these construction to be built using prevailing wage. So one of the things we gotta think about here is 179D in particular, even 45L. I mean, basically the theme here is, you use prevailing wage, you're going to be able to benefit from these new higher rates, new higher attractive incentives. If you don't use prevailing wage and meet the apprenticeship requirement, you're going to end up falling down into a lower category and a lower rate. So, I mean, I'll get into the nitty gritty of it, but for the most part, that is the the overall theme and the overall motivator behind Inflation Reduction Act, is, at least as it comes to these energy tax incentives. So some of the changes that we got coming up, and like I mentioned, prevailing wage is going to be the marker, the yay or nay, the go or no go as far as getting this higher incentive. So historically, 179D has been $1.80 per square foot, and recently got kicked up to $1.88 with some inflation adjustments that were built in. And now we're seeing the opportunity to potentially get up to $5 per square foot on these projects. So I mean, now it's really created a ton of buzz in the space and a ton of excitement around these incentives. Got companies who have previously been on the fence with using 179D and essentially have sat here and said, hey, it's just not worth it. We don't want to take advantage of it. It doesn't make sense for us. There's not enough money. We don't want to create a process internally, et cetera, et cetera, et cetera, to monetize these incentives. They've now started, coming back to us and saying, hey, we really need you to take us down this path. We give in. We wave the white flag. This has been around long enough. Now it has some longevity. Now we have the opportunity, looking at 10 years, to really use this incentive, monetize it on our projects, have a more forward-facing view of the potential and monetization of these incentives, on top of the fact that now it's the dollars are more attractive, right? So there was a ton of excitement, around that space. Had been having, I don't know, I feel like my tongue's going to fall off. I'm on the phone constantly having discussions with clients and 20, 30, 40 calls a week. It's been pretty intense for the past couple months. So just shows the level of activity and excitement behind the potential incentives that are coming out. So a little bit here. So now we're looking at potentially $5 a square foot. And again, like I mentioned in the previously, meeting the prevailing wage and the apprenticeship requirement is going to determine whether A, you get the higher deduction, or B, you end up with the lower deduction. So in the case of 179D, one of the main changes that they made is that they pretty much got rid of the previous way it was done, where it was done either whole building or broken out into individual categories. So now they've done away with that, and they've dropped the initial qualifying benchmark to 25%. So now we have to beat the ASHRAE standard that's in place by 25% in order to achieve a minimum deduction of $2.50 if you meet the prevailing wage and apprenticeship requirement. And I'll get into what the prevailing wage and the apprenticeship requirements look like in the next slide, but just keep that in mind. So one of the key focuses here is A, you got to meet that prevailing wage. If the project is built using prevailing wage, then you can qualify for this higher amount here. If you look at my mouse, hopefully you guys can see it, but you'll see that $2.50 per square foot would be the starting point. Now, each additional percentage point of energy tax of savings against the ASHRAE, energy cost savings against the ASHRAE baseline, is going to generate an additional 10 cents per square foot. So 25% gives you $2.50, 26% gives you $2.60, 30% gives you $3 a square foot. So it's a moving target based on how efficient that building is and where it falls from an energy perspective against the ASHRAE baseline. And again, that's something that, for the most part, you shouldn't be worrying about that part of it, whether or not the building's efficient, whether or not you're meeting the requirement. Realistically, bring in an expert like Walker Reed, bring us in on that part of helping you analyze whether or not these buildings meet the requirement. That's the part where we're going to add a ton of value. So we're an engineering firm that knows too much about tax, just enough, too much and just enough to be dangerous, essentially. But our core focus, what we specialize in, what we pride ourselves in, and what, where the foundation of our company is, we're really an engineering firm. And this is an engineering based incentive. This is not even though it's a part of the tax code, it's really focused and where the value is and where the expertise is based around engineering, specifically mechanical engineering. I like to bring that up too, because we're mechanical engineers here. So, and all the energy studies and all the energy components, most of the time are happening in that mechanical engineering world. And that's where we add a ton of value to you guys. And, now there's literally a dollar amount, and a percent per square foot added to the value we can add. Because, if somebody comes in and says, hey, yeah, you definitely qualify, but, you're going to be 28% because they missed some parts of the analysis, or they didn't go in, field gather, grab all the information that they could have grabbed when we were modeling this building to potentially, model it and save you additional energy. Now you're leaving money on the table for previously, as long as you hit whatever category you were looking for, you get those partial deductions. Not that big of a deal, right? But now you potentially could leave, every percentage point is going to cost you 10 cents per square foot. You start multiplying that out over buildings, over your tax rate. You're talking about real dollars in your pocket that could potentially be missed out on. So that's the key there. And like I mentioned earlier in the webinar, the theme here we behind Congress and this bill, the IRA, is if you don't do prevailing wage, you're going to get penalized, right? There's a penalty, and the penalty is pretty drastic, right? It's even at $1.88 per square foot. That was the previous max, without prevailing wage. If you're not meeting the prevailing wage requirement, now you're at $1 per square foot. So they're giving you a 88-cent haircut on not meeting the prevailing wage. Again, $1 per square foot. There's a lot of projects in certain parts of the country, certain non-government projects where that's going to be the case. They're not going to do prevailing wage, right? $5 a square foot is attractive, but I don't know if it's enough money to drive a business decision around making a project be prevailing wage or not, right? So that's going to be something that the marketplace will tell us throughout the years, and there'll be business decisions there to be made. But I mean, if you're a CPA, or if you're a CASA group, or you're in the consulting business, this is something you need to know. It's something that you need to bring up to your clients, have a conversation with them. Maybe they're in a market where, I don't know, they're 80-90% there. They're already paying prevailing wage. They're already meeting most of the requirements. It's just making a couple more moves, and maybe there's a subsector or a subcontractor that they have to bring into the fold to potentially take advantage of the prevailing wage. And maybe the $5 now becomes attractive to them, where they go, hey, if we have this very minor marginal additional cost on this project, we could potentially now go in and claim the $5 per square foot, which means XYZ number of dollars to our bottom line. And it's a business decision, right? So just something to think about, some of these analyses that, these are things your clients are going to come to you. They're going to ask you these questions. They're going to try to get clarification on them. So it's definitely a topic that you should be somewhat, at least high level, informed about. And the worst case scenario, right? The tax law, the notice behind this prevailing wage isn't that complex. It's not all that complicated, right? So it can be looked at and analyzed. You can dig deeper into it at that point in time, but just kind of keep in mind that this is going to be a pivotal decision-making point in some of these projects, and some of the opportunity that your clients are looking at, specifically in the energy world, and guys who are doing work in government. I call them mush markets, the secondary market, tertiary markets, that prevailing wage may not be required on that job per the government's requirement. They don't need to submit a certified payroll. It's not something they have to do, but for the most part in that region, maybe they're already there. So that's something that needs to be looked at and analyzed, and see where the value is and whether it makes sense to make that business decision, move forward or not. So very important to note that these changes start in 2023. So any projects that were previously placed in service in 2022 or before, essentially the pre-IRA rules apply to those projects in particular. But the ones that we're looking at moving forward, you're in a pretty good position. They're going to be the post-IRA rules, and you're going to have to now start looking at these kind of different events that are occurring here. So, all right, let's talk a little bit about the prevailing wage, the star of the webinar here. So they issued this notice end of I think it was November 29th. The notice came out by the IRS, which that's a couple good signs behind that notice being published. One, the IRS looks like they're moving pretty quickly to establish some of these IRA bulletins and notices to help provide some guidance, right? So, notice isn't tax law, but a notice is still, it's almost like your standard operating procedure when we look at it from our point of view and how we have to do things in order to be compliant, and what the auditors are going to kind of point to. Sure, we could take something to tax court, fight it, argue law versus notice and whatnot. But for the most part, you kind of want to maintain status quo and you want to fall within the realm of compliance, you want to kind of follow these notices. So hopefully, and this is a big hopefully one, we're waiting on the notices for the 179D changes and the 45L changes to come out. We're hoping that those notices come out here pretty soon. I know this week some other IRA notices popped up. And so it seems like the IRS is working on it. They realize that this is going to strive some business decisions. So we're expecting to, call it first quarter, to start seeing what those notices look like. Around 179D, the notice is needed. It's not as it's not going to be as dramatic or drastic of a situation. But the 45L is a big one, right? The 45L they made a huge overhaul to the 45L. And that notice would be very welcome at this point, because there's a lot right now. I can't tell you with any certainty exactly how we should be doing a 45L or not, right? I have a great idea of what it should look like, but it's not uncommon for the IRS to come out, make changes from the law, point to sub parts and bits and pieces of the components that have been called out within the law and the bill. So we just have to wait and see what they do, so that we can start helping you guys comply and take advantage of some of these incentives. So let's dig into prevailing wage. So starting in 2023, any project that gets that's going to get started, going to get built, those projects, in order to take advantage of the higher rates, both in 179D and 45L, and I'll get into the 45L later, but in order to comply take advantage of those higher deductions and credit amounts, you're going to have to meet prevailing wage. So a couple requirements on that front. One, you're going to have to maintain records for the fact that all the laborers, mechanics, subcontractors, and whatnot on that project were paid prevailing wage. Now, prevailing wage is it's defined within the notice, and I can send at the end of this webinar, I can send out together with the presentation the actual notice, so that you guys can read through it and dig into the nitty-gritty of it. But those so pretty much the general gist of it is that everybody on the project needs to have been paid whatever the prevailing wage is within that region, within that zip code, within that city location, whatnot. And those are all published rates they fall within sam.gov has them up and published. So, if you're starting a construction project and it's getting going, at some point in 23, 24 and beyond, and you want to take advantage of this, or you're being asked, maybe it's a project that you already have to meet prevailing wage, you're going to have to look at these what's local rates for that region, and then you're going to have to build this into your subcontract agreements with any of your subcontractors, because it's going to trickle down to them as well. They're going to have to roll up a certified payroll to you guys, something that you keep within your records, and you're going to have to keep that and basically gone through a good faith effort to maintain all these records and make sure that the prevailing wage was paid throughout the project. If for whatever reason within whatever region you're looking to do the construction, the project, the renovation, the remodel, whatever it is. If, excuse me, the prevailing wage is not published, you're going to have to actually reach out to the Department of Labor and request that they issue the wage rates and the wage determinations for that zip code, for that region of that project. So, and you're going to have to document that you did that. You're going to have to keep those records. So there's actually going to be some burden on you as a taxpayer to go through and request and make sure that you're paying the accurate wage for that region, and keep that. And there's going to be that record keeping requirement as well. Another component to the prevailing wage is, now apprentices have to make up 12.5% of the total hours on the job. So, you know, union job, prevailing wage, you know, it shouldn't be hard for you guys to find apprentices, but for the most part, if for some reason within that region, maybe you're doing a prevailing wage job in a non-union city or state or region, in the case where, you know, you can't find enough apprentices to make up that 12.5%, and you've reached out to all the qualified apprenticeship programs in the area, and you've made a good faith effort essentially to do so, you know, you can be exempt from this requirement, but you're going to have to have records that, you know, you went through the effort, you know, good faith effort to reach out, try to obtain the apprentices to do the work on those projects and to make up that 12.5%. And again, maybe you're at the highest level of this food chain, and this is something that you're going to have to mandate on your subcontractors to do. This is a subject that I had yesterday. I was on a call with one of my clients, you know, with their in-house counsel, you know, as they're trying to figure out how to navigate this path, write this into their agreements and contract documents. So just mentally prepare that you're going to have to kind of bring in, you know, your attorneys and whatnot to account for, and, you know, kind of handle the trickle down effect of this, and make sure that operationally you have a system in place to basically have all these records flow up so that you can keep them, and you have these submitted payrolls and submitted information as part of your record in your books. So that's going to be another important component. And again, you have the ability to exempt yourself from using the apprentices, but you'll have to do so, and you'll have to make a good faith effort to try to get there and try to get them on board for this project, for whatever project you're looking at. Something to keep in mind, there's a bit of a window, right? So, you know, all of a sudden the IRS says, you know, the Congress says, hey, new bill, you know, new rules, they start in 2023. There is a 60-day window from the day the notice was published. So essentially any projects that got started on January 30th or before, and have been, there's a couple rules here, right? So there's definitions, and I highly recommend that, you know, don't take 100% my word for your interpretation of these things. I really recommend that one, you know, if you're going to take advantage of this, you know, kind of window of opportunity that we have here, I'm going to recommend that you look at that 30, you know, that 60-day window, and look at all the rules as far as what does the beginning construction look like, and what does it look like as we go down the path, you know, of having continuous construction, and making sure you're going to be able to meet all those rules to take advantage of the higher rate. So, so 60 days, starting January 30th, any project that commences, right? And the definition of beginning of construction is, one, there was substantial work. And we're not talking about pre-construction activity like engineering, permitting, and these things. We're talking about actual substantial work that is done on these projects. You know, again, the definitions falls within the notice. I'll send it out after the call, but you know, there has to be substantial work that starts. The other baseline or test essentially that the IRS has put out there for making that determination is the 5% safe harbor rule, and doing, you know, picking up what that looks like and what that test is, as far as, you know, having spent 5% on the project of the total cost, and that's another one. But even with whether it be the substantial construction rule or beginning rule, or the test around the 5% safe harbor, and looking at the cost being spent, you have to really analyze and look at the fact that the construction has to then be continuous after that point, right? So there has to be an ongoing construction, and there's a time period in which how long you have to complete this project on that continuity. So again, you can't just go, hey, we're gonna, guys, fire up the crew, let's go take a picture with our ribbon cutting and stick a couple shovels in the ground before January 30th, so that we can take advantage of this incentive, and then walk away, go into permitting, and wait to get started for the next couple months. That's not going to fly, right? That's gonna immediately kick your incentive back if you get audited. You're gonna have issues kind of around that situation. So that being said, let me so that's the overall high level on the prevailing wage and whatnot. So I'm gonna dig in. Seems like I got a question. Let me take a look at it. So it says, when you say taxpayer in regard to the responsibility to obtain and maintain the prevailing wage parentheses record to comply, I assume you mean the building owner taking the 179D. It's a good question. When is a governmental or non-for-profit owner allocating the deduction of the design record? How can the architect or engineer reasonably be expected to get this information from all the contractors, subcontractors involved who were not contracted by them? So it says that the Department of Labor webinar yesterday didn't address this topic. So thanks, Tom, for submitting that question. I appreciate it. And that's honestly the question there, just to kind of reiterate it a little bit, is, so in the case where you have government contractors, government architects, designers getting allocated these deductions, how are you supposed to take advantage of this incentive, and how are you supposed to record keep when you don't really have access to these records? And that's actually a great question, Tom. I foresee a bunch of issues around this topic. I don't know if I have the right answer, but for purposes of 179D, and for purposes of when you're getting allocated this deduction, you essentially become the you kind of assume those responsibility of the taxpayer on behalf of, you're getting allocated this. So now you're almost being treated as the taxpayer. So the way I'm understanding it is that your taxpayer, the designer, is still going to have a responsibility to obtain these records. And they may have to go into, whether it be public records or do a record request with the government agency as part of the allocation process, to get that information and have it trickle back down to them in order to be able to take advantage of it and maximize at the higher rate. I have a feeling that this is going to be one of those areas that hopefully gets clarified in the future. A lot of times the IRS puts these out, they put the notices out, and they don't really think through all the different scenarios in which the end users could be affected by this. But you're right. Like, why would your architect, designer have any access to these information as far as the cost and the construction and whatnot? But they're just like, as part of the allocation process in the past, they've had to get the total cost given to them by the government agency. They're also going to have to get something as far as the compliance goes, or some record of this information. And maybe that the way this ends up playing out is, maybe when we see the notice around the changes to 179D and the changes to 45L, I'm hoping the IRS maybe puts in some recommendation, but puts in some requirements for the allocation letter to have a statement in it, or have some sort of affirmation that prevailing wage was done on the project together with the rest of the allocation letter information. So a normal allocation letter would have the cost of the project, the government agency's name, the designer's name, what's the building and whatnot, what's the deduction amount that's being allocated. But maybe it'll also address, or have a statement or something that addresses that the prevailing wage was being met, and hopefully they address this and kind of takes care of that that issue that we're going to see, because it'll definitely be an issue on not just your client, but it's going to be something that I foresee being a problem generally down the road quite a bit. But there's still going to be some record keeping requirement, right? But maybe there's a way that they can pass that out, that responsibility on, and essentially allocated as part of the the allocation letter process. So that's what I expect, but it's going to be, I have to wait and see once the notice comes out. And that's a tough thing with these things, right? We want to be timely. We want to provide you good information. At the same time, we don't know if we're going, but some of these things we're going to have to kind of wait and play out and see how they come out, and see if the future notices address some of these issues. And just like back in 2011, there was some confusion around the use of the 3115 and the use of for 179D when it came to designers, and the IRS came out and specifically addressed it in its own notice and kind of answered that question. This might be one of those situations where enough people have started to have problems around it and start calling the IRS, start calling the office of Jennifer Bernardini's office, and start bugging them, and they'll make a notice out. They'll put some clarification around this, because it's definitely going to be a situation that needs to get addressed. And again, maybe I think you being a practitioner and whatnot, at the end of the day, I think we have to make a good faith effort to comply, right, within reasonable standards, and trying to meet the requirements within a good faith effort. I think that's going to be one of the, as we kind of charter some of this uncertainty, that might be one of the best ways to address it. So, all right, let's take a look at some of the changes coming up. And like I mentioned, I'm going to get into some of these new changes coming up, 179D, some of the changes 45L. Then I'm going to go back, jump into the original plan of 179D and 45L, what they look like previously. So some of the other key relevant changes is that now non-for-profits may allocate this deduction to the designers. So nonprofits are now able to take the 179D and allocate it to designers of the energy efficient commercial buildings. And when I talk nonprofits, I mean any nonprofit, tribal government, in addition to the government agencies. Again, my expectation, and I've said this on a couple different calls and a couple different things, but my expectation is that those rules should mirror each other, right? The government rules, these new nonprofit rules should end up mirroring the allocation rules. But we may be surprised. There may be things that the IRS is looking at that they come out with a completely different mindset and rules for the way those allocations are to be made. We'll have to wait and see what the notice comes out with. So big change is coming to 179D, new qualifying methodology around energy use intensity for retrofits. So it's essentially going to be a secondary methodology. Just like in the past, we've had the prescriptive method to model, to be able to take advantage of 179D, specifically around lighting. This is going to be somewhat of a different methodology that 179D can be done. So you can go down the conventional design, modeling, modeling style of taking advantage of 179D, or you're going to now be able to take advantage of this new energy use and intensity situation, which is essentially, I call it the measurement and verification analysis, which is basically you're and again, we're waiting on notices. So, take everything I'm saying about this with a grain of salt, because the notices may dictate differently on how this is going to be run. But the idea and the general gist behind this is that you're going to come in at the beginning of a project. You're going to analyze, create a baseline, determine what the energy use is of that building. Then a retrofit's going to occur. And then a year later, after that point, we're going to come back in, verify that the retrofit that was done is actually saving energy and how much energy is actually being saved. And based on that percentage, we're going to generate a 179D incentive. And it's going to be taken, that's going to end up being taken at the end, right? So once it's verified, that'll be the year it'll be placed in service for the terms of this incentive. So that's the idea. Honestly, where I see the potential use here, and we're going to, kind of hanging my on the edge of a cliff here, waiting to see what happens. Is where I see the opportunity lie is potentially in some of the other technologies, hopefully like solar, and some of the other technologies that are out there that are saving a ton of energy on buildings and creating real energy cost savings. But we don't currently have a methodology to model them or take advantage of them under the standard methodology of taking 179D. So that's the other piece that we're hoping for. We're hoping that this will expand the incentive pretty drastically. We put in tons of information and requests through a couple different sources, couple different trade organizations, ourselves directly as part of the IRS bulletin, not IRS's request for commentary for the notices around 179D. So that was one of the areas that we hit pretty heavily through some of these different trade and energy organizations and whatnot. We were together with USGBC, NIESCO, and others that we kind of teamed up with, and that was one of the areas that we really hit on. So hopefully this will help expand the relevancy of 179D and the usage of it in the future. So one more thing that I want to touch on before I jump into some of the other stuff is that now you have the ability to take advantage of 179D fully once every 3 years if it's a private owned building, or once every 4 years if it's a government owned building. So now you have projects that have multiple phases and they're having work being done on a regular basis. It's no longer a one-time deduction. Previously, if you did call it lighting retrofit, the building qualified for $1.80 a square foot. Now you took the full $1.80 a square foot. It was a one-time deal. That building was done. You could never take it again. So call it, 10 years later, that building had a major, HVAC improvement done, and there was no way to monetize the 179D or take advantage of that incentive around that new project. And even though it was a major capital spend, major energy saving component, there was no way to take advantage of it. So now every 3 years for the private sector, private owned buildings, every 4 years for government tax exempt buildings, there's the ability to take this incentive again. So that's a key big one that I think is going to really help out a lot of folks, especially in my the ESCO industry and energy saving industry who do a lot of phase 1, phase 2. I got some of these clients who are doing phase 10 of some of these projects, and every time they do a project, there are millions of dollars and tons of energy savings around some of these very large facilities and buildings. So all right, so let's jump into my rant. This is my rant. I love this rant. It's one of my favorite rants. Key important part of 179D and designers. I bring this up on all my calls. Don't judge me for using the same slide. I cheated for my prevailing wage and I copied that slide and redid it. So, really important. IRS is throwing a ton of money at enforcement. As part of the IRA. One of the low-hanging fruits around 179D particularly is who should be getting these deductions assigned to them. Keep in mind that in order for one of these deductions to be allocated, they need to be allocated to a designer. It's defined within the bulletins. It's designed within the tax code. It's really clear. A designer is somebody who does not merely just install what somebody else designed. Just because you have a contractor who got involved on a project, they bid on it. Somebody else drew the plan. Somebody else did the specifications. They bid on it. Then they get on site. They propose some changes. They do some. They create some shop drawings, and maybe they propose some minor kind of value engineering things around the project that, some of it may or may not save energy or whatnot. Let's say it did save energy, but just merely doing that small activity and not being the primary designer and primarily responsible for the design is not going to really cut it for them to take advantage of it. It's an area of audit. It's an area that's getting looked at left and right by the IRS. All the IDRs and all the audits that we see, or at least in the last 4 or 5 years, this has been the main topic, the main theme behind all those IDRs is whether or not those projects meet the designers being allocated the deduction and not merely just a contractor that was hired to do this work. Okay, so we left it up to the private sector. private sector got really creative and just started giving these things away. A couple bad apples in the industry started kind of just being really aggressive around the definition and the gray area per se that existed there. And it, this made it on the IRS's watch list. It's something that happens very often. So, I mean, if you're a CPA and you got a client, they're a contractor and they want to take the 179D, it has to be in a scenario where they were primarily responsible for being the designer of that energy efficient property. So they had to have been contractually responsible for it. They need to have been primarily involved in the design, or at least have the responsibility for the design. So that's a key area that you just need to look at. And it's kind of the danger zone when it comes to 179D. So that's my rant over. I'll keep going. Take a quick look at the 45L and 45L upcoming changes. Current version of 45L is $2,000 per unit, per residential unit, per dwelling unit. And that's for any project that's been placed in service through 2022, that's going to remain relevant for any of the 2022 projects. So it's going to be great. 2022 is going to be a great year for all my 45L folks. We're going to be able to certify it under the existing methodology, the existing systems and whatnot. Moving forward into 2023, the bright side is that these credits are not going up. So, for multifamily in particular, multifamily has to meet the prevailing wage, and the multifamily is going to have the opportunity of a $2,500 tax credit. And the new homes, and if you meet Energy Star, and I'm going to say that very broadly and very, high level, we don't know what that looks like, right? I had a conversation at a conference with competitor, good folks, not bad mouthing them at all, great people, and he was going, well, it's going to be Energy Star, and I'm going, well, hold on, there is no notice yet. It still needs to be, verified and confirmed. It will be, I agree with you that it's going to be Energy Star, but, what version of Energy Star are they going to do like they've done in the past? And are they going to revamp Energy Star and make you comply with certain components of it? Are they going to change it? Are they going to adjust it? We don't know. So we got to wait for that notice to come out. Some of the questionnaires and some of the questions being driven around the IRS's request for public commentary around the 45L kind of led to imply that they are thinking about making changes to this. So that's another piece of that puzzle that I'm not 100% sold. And I've had tons of this conversation with you guys around, hey, I don't want to have you go tell your client taxpayer that, just go do Energy Star and you're good, because you may or may not be. And that's my take on it. That's my opinion on it. That's where I've been. Hopefully we receive guidance sooner rather than later, and then we'll have another webinar. You can listen to my beautiful voice one more time, and we can get into the nitty-gritty around that, what that's going to look like. But the other piece to this too is, there's this idea out there that now these multifamily can be, there is no story requirement, and that sounds like a great thing for me. I would love that, but we're not 100% sure of that either. I haven't seen that confirmed anywhere. We have to wait and see what this notice looks like and where that guidance lies. Same thing. So multifamily needs to meet prevailing wage in order to qualify at these higher deduction rates. If they don't qualify, they're going to get kicked back to $500 and $1,000 per unit. So that's going to be a tough kick in the pants for those for that industry. Something we have to wait and see what happens, wait and see what the notices look like, wait and see what the compliance models look like, and then we can make some determinations there. Good thing is that the home builders are not going to have to comply with prevailing wage in order to take advantage of this. So that still will be a decent opportunity for the home builders. So, all right. Anybody have any questions up till now? Like I said, I'll jump in at the beginning. If anybody wants to jump off, you're not going to offend me at this point. I think you guys have, you got the meat and potatoes of it, but I'm going to jump back to and look at the opportunities around the original 179D and what that looks like today, and what you can take advantage of for pre-2022. I have one question. Is the date commencement for 179D the same for 45L? Yeah, pretty much. The new IRA, Inflation Reduction Act, changes are going to be the same. It's everything is starting January 1st, 2023. The new rules will apply to projects placed in service in that time frame. So thank you for that question. If anybody else has anything else, I'll be here. Hold on. All right, got some specific questions. Thank you. Says this, I have a prospect that leases a 26,000 square foot property. They're improving from a frame shell to a usable manufacturing site. We talked about cost seg for LHA. Would they be eligible for 179D? They started a while ago and think the place in service date February 2023, and they could get $5 a square foot without the prevailing wage requirement. Yes, they could essentially take 179D, probably be a good candidate for 179D. The only thing I would look at is, can you take advantage of qualified improvement property rules and take advantage of, with the leasehold improvements and be able to just write it off. I mean, so I'm going to get into how 179D works here shortly, but because it's accelerated depreciation, I mean, if you have another vehicle to write off your tenant improvement, your build out, and do so without having to have an engineering study done, I would love to charge you for an engineering study. It's how I make a living and put my kids hopefully through college and whatnot here in the future. But I don't want to take your money if you have a different methodology of writing the stuff off without needing our services. So that may be the better path for you there as you look at the opportunities for your prospect. I think the special leasehold improvement rules under QIP changes that happened a couple of years ago might be the better path. So all right. So that being said, this last slide here talks about how great we are and how wonderful what Walker Reed is and all the amazing things that we can do for you. So, the goal here is that we're always going to make things as easy as possible for you. We're going to try to get you the maximum incentives available. We're going to do so hopefully at a lower cost than most. And, we're going to provide tons of flexibility and make your life extremely easy. So just keep that in mind as you're choosing your next provider, or if you're a competitor on this call. I feel very honored that you were on here listening to me. So thank you so much for that as well. But again, we're here to be your partner, and even my competitors. I mean, there's great opportunities in working together with Walker Reed. As far as from an engineering perspective, there's a lot of things we can add value to you guys and help you down the path, and do so in a way where it could bring a lot of opportunities to your client, and maybe even reduce your overall cost and operating cost of doing business and taking advantage of these incentives. So feel free to reach out to me. We can have some of those conversations. We've created some new programs for you guys specifically since the IRA to help some of these competitors take advantage of our expertise and our infrastructure in 179D and 45L. So feel free to reach out to me. I'd be happy to discuss some of that stuff with you and potentially hopefully lower your costs down the road and how you operate and how you do business. So all right, so let me jump in to what 179D previously looked like and what 45L looked like in the past. So a couple things. So 179D, we look at it, and I see some questions popping up. I'll get to those at the end of this. So 179D historically has been looked at pretty much from two very specific categories. One, you got the 179D in the private sector, and two, you have the government side. So it's two different. It's one incentive that's operates very similarly from an engineering perspective, but the benefit is very different from both points of view. So number one, you got the private sector. The private sector is an accelerated depreciation incentive. That's the key here. It is a timing difference. It's the benefit comes in the form of a net present value analysis and the cash flow that gets generated by moving your asset from a longer life asset to a shorter life asset, moving it from 1250 property year one, right? Taking your 1250 property and bringing it into year one. So it's going to look at that later life asset, 39-year, 27 and a half, depending if you're residential or whatnot. And we're going to look at those components. We're going to analyze them, and we're going to reduce that. We're going to be able to take up to $1.88 per square foot in year one. Very similar to bonus depreciation, very similar to the benefits of it, like a cost segregation study. If you're familiar with it, that's going to be how the benefit plays out for you in the past. And look, 179D is going to still, even at the $5 a square foot, in the private sector, the benefit will still be the same. It'll still apply the same way, and it'll still be used in the same fashion. But the key here is, in the past, anything 2022 or before, you can do so and take advantage of it up to $1.80 per square foot in some years and $1.88 in others. And then we got the government side of it. The government side is, again, still $1.88 per square foot, but it's now being allocated to you. It's being taken as a deduction on the designer's bottom line. So that's the key there. And then we'll look at 45L. 45L, I'm kind of looking across here at the benefit of doubt. It's $2,000 per residential dwelling unit if they meet the energy criteria. So taking a look at who can benefit in the private sector, pretty much commercial building owners are the ones, right? Owner occupied, investors, anybody who owns, and they're looking at owning these properties for a long period of time. That's the key here, is that they have a long-term hold strategy. And when I say long-term hold, right, like the break even on a 179D study is about 3 years. Anything after that, is kind of putting you in the positive. And I usually say people, hey, if you're planning on holding this 5 years or better, you're in a good position if you have the tax appetite to take advantage of the additional accelerated depreciation deduction. I always tell everybody, my cost seg folks, you're welcome. But I always tell everybody, I had tons of calls with developers and whatnot. I say, hey, do a cost seg first. That's going to be the key. You're going to get more bang for your buck. Do a cost segregation study first. Take advantage of that. Take advantage of any bonus and special incentives that are out there. And then do a 179D if you still have tax appetite to do so. It's a more expensive study. It's a different level of analysis. And it's going to be just better for their bottom line. So that's my plug for the cost seg folks on the call. I do that very often. I recommend folks to do a cost segregation study prior to doing a 179D. Again, we don't do cost seg. We don't recommend folks for cost seg. We work with all you guys. We love all my cost seg people equally. So I don't want to piss any of you guys off. So we work with all of you guys, and we provide. We love working with you. So. 179D, when it comes to the designers of energy efficient commercial building property, I talked about it in the previous slide. The designers can get allocated this deduction. So that's a key component there. Architects, engineers, energy companies, lighting companies, folks who are primarily involved in the design, can take advantage of that. 45L, when we look at it, is going to be looked at for pretty much developers. I mean, it could be major renovation, but it has to be really, really major. Talking about bringing it down to the studs. So that's going to be some of the key there. But it'd be basically developers or anybody who's building new construction, multifamily apartments. They could take advantage of it. 3 stories or less when it looks at 45L. And when anything that's 4 stories or more can take advantage of it on that point of view. Different projects types, kind of mentioned new construction or retrofit when it comes to the 179D, and major construction when it comes to renovation. So as far as the deadlines go, well, 179D was previously made permanent in 2020. Now with the IRA, these changes apply for the next 10 years. And we'll be looking at, and I'm sure they'll come up with other changes or make some adjustments down the road. And with 45L, it expired at 12/31/2021, and it got extended as part of the IRA for 2022, and then 10 years beyond that at this point. So good opportunity there. As far as what qualifies when we look at 179D in the private sector and government side on the 179D, hey, we're seeing 90% qualification or better, and I'm talking about the higher level, right? So most of the projects we're certifying, we're looking at achieving the higher deduction amounts and higher benefits. So that's a good sign. Residential tax credit for 45L. We see more of an 80% qualification. That one's kind of all or nothing, no partials there, but still pretty good results in that space too. And one of the reasons that the results are so good is that currently and in the past we've been working off of ASHRAE 90.1 2007. We expect that to be the standard here. Kind of re-looked at some of these laws, looked at some of these things. We expect ASHRAE 2007 to be the standard for the next, call it 4 or 5 years, maybe a little less, but we're going to be within this realm of this standard for quite some time. And the residential tax 45L has, now we're looking at a 2006 standard for ICC. We're going to be looking at a brand new standard for under the IRA changes. We'll see what that looks like. So all these required an independent third-party certification. 179D, it's professional engineering that's going to perform the models and site visits. Once 45L is a HERS rater that performs modeling and site visits. So that's the key there. But so that said, I really want to thank everybody. I got a couple questions I'm going to go through here. One question was asking about the ASHRAE 90.1 version is being used. What's it going to be with the new version? Again, barring some change with the notice, we expect it to be 2007 for a couple of years, and then it'll probably bump up to ASHRAE 2016. Will be the next change. So we got some time there, and there's still some great opportunities as far as the qualification comes around 179D from that point of view. So, all right. So other question, it says on 179D calculation, previously all 3 systems had their own qualifying thresholds, totaling 50%. So HVAC was 15, lighting was 25, or I'm sorry, HVAC, well, it was actually changed. So lighting was 25, HVAC was 15, and envelope was 10 previously. And the deduction rates were allocated across each one. Most recent, what are the changes in the count currently? So that entire thing went out the window. I kind of mentioned it at the beginning of the call. We're no longer looking at these as partial analysis. Now we're looking at the entire building, and we're doing an entire model across. I mean, we've always done it this way, so it's not really that different from the way Walker Reed has kind of operated. So the way we've done things is we've looked at the entire building, tried to get the entire building to qualify for the 50%. And if it didn't qualify for the 50%, then we would come in and look at the individual categories. It's actually the way it was intended to be done from the beginning. For some reason, the folks who've kind of went out there, marketed 179D and started doing this stuff, I don't know why, but they decided that everything was going to be looked at compartmentalized into the different categories, and that wasn't the right way to do it. You look at the whole building, try to get the whole building qualified, try to get the 50%, and then if it doesn't qualify, then you can look at each category, assuming basis and cost was spent within said category. So that's the way it should be done. That's no longer the case. That's completely out the window, starting with the IRA changes. Now we're going to be looking at this from each category individually. So thank you for that question. I appreciate it. And then the other question is do we still have to allocate the deduction across all 3 systems? No, in this case, you're going to be looking at your 39-year basis asset, and that's going to be your 39-year basis of the building. That's going to be kind of the allocation. I assume that's what you're talking about, unless you're talking about the allocation of to the government-owned buildings. In this case, you should have never really been allocating it that way. You should have been allocating based on the entire cost and what amount of 179D was being allocated from the government building owner to you. But if you're talking about the depreciation allocation, you're again, we would have looked at the entire 39-year asset and pulled out of that bucket based on those improvements. So again, so I appreciate everybody's time today. If you have any questions, anything you need, feel free to shoot me an email or touch base. My information is somewhere on the end of the slide. Let's put it up here. There it is. So information's there. If you need something, I'm looking forward to helping you guys. And thank you so much for your time today. And I hope everybody has a wonderful holiday coming up. Thanks.